So thank you. So in today's session, which will be about 45 minutes maybe, is about the life cycle of the market, and I'll show you some reversal charts. You may have seen it, those charts before, and there are 6 charts, and I will explain to you something about life cycle and where the traders go wrong. So here's the chart. I got it. I didn't prepare it. I got it from the internet. So take a look. This is the way the traders react. And this is something happening for last 1 month right now, since January 4th or maybe little early. And I don't know when it will end, but whenever it ends, the market should tell us, and then we need to take care of our position on the other side. So this is the way the traders or the market works. So when the market, so on the left side, when the market is showing disbelief, when the market starts to rally, traders don't believe it. It's disbelief. They say this is just like any other rally, a fake rally, and they stay in the sideline, and the market just, the stocks just keep moving upward, 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 and by the time they realize, it's too late. So most of the traders, they when they realize and they come to know when the market is too late is when others are making too much money, and we hate seeing people make money. So that's the reality. We hate when others are making money and getting rich, and we are not. We are on the sideline. We may be on the sideline because we got hurt before and all that, and we don't believe. So this is the way the market. So this is a long-term chart. So this is not something, but um, we can take the same chart on any cycle, on any length, and then see it on a lower level time frame. So this could be a yearly chart, or a decade chart, or it could be the same as a 5-minute chart. So the market works as a fractal. So what you see on a yearly chart, the same thing is happening on a 5-minute chart. What we are seeing in our yearly chart, if nobody tells, if people does not show you the timeline, then you should not know which timeline this chart is the same. So what you look at the 1-year chart or a 5-year chart is the same as something going on a 5-minute chart. So market works on a fractal basis: 5-minute, 30-minute, yearly, monthly, daily, weekly. So this is the, let's say, the monthly chart. So here is the hope, the market recovery is possible, then the optimism. So this is where we could be: optimism, this already is real. Then we get into the belief and time to get fully invested. So people are coming here the time to get fully invested, whereas the big boys, they have invested here at this level between disbelief and hope. And by the time the retail people, the traders who think they I'm a genius and we are all going to be rich, they are getting it here on a euphoria level. And they say, I'm very pleased with my investment. They're thrilled. So I'm very pleased with my investment. And this is where you hear people borrowing on credit card, taking on second mortgage, and selling their other assets and putting the money in the stock market. When the market reaching this level, I get a lot of inquiries from traders who want to join, and they sign up, etc. They are not signing up at this level. They are not participating in this. They want to sign up for the services here, so it's okay. And then euphoria, when the market, we become complacent, greed and buy, because we are not paying any attention to how long the market is moving, whether is the whole market or is a one stock. We just keep buying without any plan or no reversal. There's no support. There's no techniques. There's no strategy. Just buy it and catch it at the top. As long as the music music is going, you keep making money. So and then get caught. And then when get caught, we expect the market, when the market is pulling back, we expect the market is pulling back and we'll be fine. But sometimes the market pulls back and go up. Sometimes the market just tank and never come back to the level where we bought. So we get wiped out. So this goes on again and again, the complacency, anxiety, denial happening, then the panic, capitulation. So this is where the capitulation is happening. This is where uh, people are, finally giving in. Okay, I'm gonna sell everything, and I think I go on cash, and anger sets in, and then the market just reverses and disbelief again. So, uh, so this is the cycle keeps going. So if you don't want to be, if you're a short-term trader, and you can time your market entry and exits with your position, whether it's calls or puts, etc., then you can make a lot of money. Otherwise, just keep it in your retirement account forever. So don't sell anything. So this is the chart I got from internet. Now, if you break this into this form, so I will explain to you what is happening here in this life cycle. So let's say, so there are various phases. So that was a big chart, and this is the chart I colored it, and then I will explain the something to you so you can learn. So let's say this phase one. So you see phase one, red decline, like a waterfall decline. So this phase one and this phase one is the same here and here, one and one. So when the market is mm, tanking, phase one, it did something here at the top, which is phase six here, you see. So there was a distribution going on, which we failed to recognize, and we are trading, participating in catching the last, participating at very last end of the market. So the market when the market is about to fall, it does the waterfall decline. So everybody is getting out because of the various reasons. Maybe the margin calls, maybe somewhere the big fund is getting liquidated because they did some stupid investment. Mostly is because of the leverage. So the leverage kills the people. So due to leverage, margin calls, somebody is getting liquidated, and then one domino falls and another domino, and the market just keeps crashing. So at the end, when everybody is out, then that's where the accumulation process happens. So the market, when the accumulation is happening, the market fails to fall any further. So market fails to fall further, and it makes a new low, but not um, um, a new low is made, but a nearby. So if you watch the market, it's a new low is being made, but it's a nearby, not away from the previous low. So something is going on where somebody is buying and somebody is selling it. So the big boys, they start to accumulate at the very end of the downfall of the market. So this we can represent as a phase two. So there should be a different strategy at phase two than at phase one. So the big boys are buying in phase two, they're absorbing all the supply. So if you have deep pocket, then and you recognize that the bottom is forming, then you can accumulate, you can build the position in your favorite those stocks which you think are fundamentally sound and they got clobbered for no reason. So you can have any reason for your favorite stocks to buy. So the dollar cost averaging works. So if you believe in dollar cost averaging, the dollar cost averaging works here. So phase two, where the market is going up and down, up and down. So you will see a new low is made, but a nearby. Some stocks are still falling and some are beginning to gain some momentum to the upside. Then the phase three starts where um, new low is not being made. Anything you sell, it gets absorbed. So accumulation starts. So I'm expanding the base. So I'm expanding the base from phase 2 to phase 3. So on the phase 3, the buying is happening. So everything is getting bought. So you may see your individual stocks in a certain sector or industry group, or it could be the Nasdaq stocks. It could be some Dow Jones 30 stocks are getting bought, or the small caps start to participate. So whatever the selected industry and selected market. So recently, when the January 4th, on January 4th, when the market reversed and gave the signal long, it started with Dow Jones. So according to my analysis, it was Dow Jones stocks which started to move early, and then later, um, other markets. And right now, the small caps are participating for last month, 2 weeks, 3 weeks. The small caps are moving up. So this is where so if you it depends on your strategy, on your, again, it depends on your ability to buy. So if you have a bigger portfolio, you're buying it in the phase 3, building your position. So the rally starts, and we denote it at 4. So the rally starts, which is denoted at 4. This is where so the big boys, they loaded here in phase 3 and phase 2, and this is where the breakouts are happening in the stocks and the reversals and any dip um, being bought, or the new support at the higher levels are being created. Some, they hit the resistance and then they pull back and then they bounce back up in the higher level supports, and then the more the stocks which were beaten down, they start to participate. So this is where in the phase 4, this is where the most of the money is made in the market. So phase 4 is the one where the money is made very fast, and the portfolio skyrocketed if you can recognize phase 4. So this is what's happening right now since January 4th and onward. Today is January 27th. So this is where the market is. I don't know. Nobody knows how long this phase 4. It can keep going. We don't know where this phase 4 will end, but I know that this is what's happening here. So when the phase 4, this is where the market is moving. So this is where the your win rate goes uh, like almost 100%. And this is where the option straight calls work. This is where if you sell naked puts, you collect the premium. So recognize this phase, and then so when the market is moving, so a lot of stocks now, they are getting extended. So you have to be recognizing that a lot of stocks are getting extended. So there is a lot of potentials in a lot of stocks. So overall, the market is in phase 4, but it doesn't mean that there are not stocks left for you to buy. So there is something there for you. So if you do your homework and be patient, you would find some opportunity every day. Every day you find some opportunity, even though the market is moving up, you find some opportunity for the stocks to buy. Maybe there were some industry or group or industry group or sector, they were not moving, and now those stocks are moving. Maybe some stocks, they got clobbered due to earning, but they fell down on the earning, and then now they are moving up. Maybe some 2-3 days of a market pullback, and then so the market pullback, and then the market reverse up. So when suddenly when 1 or 2 day of a red day, I get the email, okay, it's time to buy puts. I think I'm going to sell and I'm going for puts. So I don't do that. You shouldn't be doing it just because 1 or 2 days of red day, and then you start to looking for puts, because after 2 days of pullback, and then when the market reverses on you, so you lose money on your puts right away. And if you want to wait, and then selectively select your out of your open position, select which one is bouncing from the support level, which one fell down and now is bouncing up, so I can do some dollar cost averaging. So doing the dollar cost averaging in this phase is a great technique. So do some dollar cost averaging in your position when it pulls back to some support level, and then bouncing up. Not just doing dollar cost averaging just because of for the sake of dollar cost averaging. So dollar cost averaging works great when the market is volatile and you still believe in the trend. So when you believe in the trend and the market is volatile, moving up, let's say, and you do the dollar cost averaging selective on a selective trade, so you make a lot of money, you pile up on your winner. So having some strategy of scaling in and having some strategy in scaling out. So work on that, and a lot of money can be made. So this is the phase where the market is right now. And I don't know. So I analyze the market and I categorize it into minor trend, intermediate trend, and the major trend. Then I analyze the strength of the market. So I do that. So I got the signal on January 4th. So long. So what happened when once you get the signal that the market is doing this, so market was doing this, and you get the signal, you quietly you need to get the first opportunity to cover your shorts. So and then build your position on the long side. So keep building the long position. So the trend is your friend till it ends, and mostly the traders they get into the trend somewhere very late. So as long as the music is playing, they are making money. So everybody is genius here. So everybody is genius at the last phase of 4 and 5. They fail all this. They fail this move. They don't recognize this move. So let's say January 4th is right here where the phase 4 starts, and it's still going on. So this keep going on. You don't know. You cannot fight the market. So selective buying. It also depends if you're trading options or if you're trading shares. If you're trading shares, maybe you're buying and keeping it till uh, till the market gives you the exit signal. Maybe that's your strategy. I liquidate all my share position when the market gives me some signal, and the signal could be a signal to exit, which is not equal to signal to go short. So signal to exit is something different than signal to go short. Signal to exit comes early and signal to go short is later. Same way signal to cover shorts come early and signal to go long comes later. So in the beginning where you are exiting from your short and building your long position, this is the temporary phase, so you don't know which way. It's like moving your car. I don't know, like a boat in a lake. You see, when you go to the lake and or somewhere on the beach, how you cannot just move the boat suddenly. So recognize that you need to slow down and make a U-turn. You have gone so far. So when you going on a like paddling or a jet ski, you keep going, 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 and then when you look back and you have a guide, let's say, on the beach, and he's waving at it and saying, "Hey, come back! You can't go that far." So suddenly you say, "Okay, so I'm going down the jet ski, and and I look at the back, and he's waving at me. Then I have to make a U-turn. So I make a U-turn, slow, 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 and then I speed up. So this is the phase. This is where the traders lose money in the phase 2 and 3. So traders make money on the phase 1. They recognize it. They become genius. They buy put today and sell tomorrow. Make money. They get caught in phase 2 and 3. So our job so over my lifetime of my work, my job is to recognize that I don't get caught too much in phase 2 and 3. This is where I get caught. I used to. Now I'm better. So this is where uh, the money is lost in phase 2 and 3, and the money is lost by the trader in phase 5 and 6. So if you and the phase 7, so you see, I'll explain phase 7, phase 5 and 6, and phase 2 and 3. If you have a deep pocket, you build your position in phase 2 and 3. You liquidate in phase 5 and 6 and make the most long going long in phase 4. So phase 4 can be divided into many, many phases. I have charts. I explain all the things which happen. So and then on the phase 5, this is where the last phase where all the um, like when people start opening their account on a Robinhood with $2,000. So yesterday I received a call, and so I give you. So I I talk to so many traders and so many emails, so I see what the kind of questions they are sending, or when I talk, what kind of a how they're thinking. So this person, so I give you example. This person, he said, "Hey, you're sending me these alerts, or I'm on your trial list, and I don't understand how to place the trade. Can someone call me?" So I said, "Okay." I told my team, "Okay, I'm going to call Antonio." So I call Antonio. Antonio picked up, and I said, "Okay, what's up, Antonio?" He said, "Oh, I don't understand this. What is going on? You're telling me buy strike. What is a strike? What is buy? What is this?" So I explained, and then I said, "Okay, who's your broker?" So he said, "Pocket Option is my broker." So I immediately look at Pocket Option, and Pocket Option says minimum amount to open an account is $50. So $50 to to open an account, and $1 per contract. So commission not bad, $1 per contract. I said you can maybe, you know, and then he asked me which broker you're using. So I gave him my broker. And I said, "Okay, Antonio, so you understand everything? Fine. You can attend the webinar, etc. And I'll give you the link." So he said, "No, I don't have time for, just tell me, just teach me how to place the order. And I'm going to put $1,000. Okay, if I put $1,000 in the account." So Antonio wants to open an account. So with Pocket Option, they require only $50 to open your account. So, and then he said, "What is your fee?" I told Antonio, only I will make money from you, and your Pocket Option broker will make money if you put $1,000 and start trading. So I cannot. So please. So he did not like my answer. So when I get this kind of you know, inquiries, $1,000 I have or $500 I have, and I want to trade, then it's kind of become scary. So on phase five, when the market move, is the last guy. So it could be the overall market, or it could be the individual market. So individual market, when the market goes gap up, and then suddenly there's no buy, there's no follow through, etc. The last phase. So we need to recognize that this is what's happening. So we get caught. It's very hard to recognize phase five and phase six, because the big boys, they are selling very quietly. They don't tell us that they liquidated. So they liquidated. They have all the resources. So imagine all the wealthy families of the world. They have trillions of dollars. They are all invested. They are liquidating. They have the resources, the institution, the pension fund, the hedge funds, the all the high frequency guys. All of them are liquidating. All the guys who have the knowledge, they are liquidating here, and then the plug is pulled, and then the market, this time the market doesn't stop. There's no uh, no dip buying. There's nothing happened. And then the phase one. So this phase one is phase one here. And then the market can go on the sideway forever. So you don't know. So we waste time. So this is the phase where we need to build up the cash, get out. Somewhere here at the beginning of phase one, get out and do some short-term trading on via puts, and then stay in cash and wait patiently for this phase two and three to happen. And then this is where the money is made, the 30, 40, 50, 60% growth in the portfolio in a very short time, as long as you recognize phase five and six. So this is what's happening. I think the market is in phase four right now. I don't know. So you see, this is extended phase four. So volatile market and a downtrend market is short term. The long-term market, the uptrend market is have a longer duration. So the longer-term market have a the uptrend market have a longer duration, and it's kind of easier market to make money on a uptrend. It can be quiet. It can be, if it's volatile, is not remain volatile for the long. It's just a little bit. So uptrend market is not a volatile market. Uptrend market is a quiet market and a great market. So in the when the Trump was, it was an uptrend market and it was quiet market, and then during COVID it was like this market, so volatile. So market, when it's in downtrending, is a volatile. So you need to make money quick. Entry and exit should be quick. Whereas in a uptrending market, if you miss the exit, market gives you another opportunity, because there is another person uh, waiting to buy from you. So this is the market life cycle. So depending on Depending on the life cycle of the market, we need to be ready to trade. So we need to have at least two kind of trading system, one for the down market, one for the up market, or you can have one trading system for the uptrending market. You just switch. You trade the those symbols which move uh, when the market is trending down. Those symbols are moving up. So you need to find out those ETFs and those symbols which move up when the market is trending down. So you can have just one trading system which gives you always give you the long signals or whatever method you have. So, but you need to have at least two systems, one for the uptrending market, one for the downtrending market, and recognizing which system to use. So do that. And if you then cannot trade the sideway market, then stay on the sideway. So don't over trade. Stay on the cash in the sideway market because the money is made in the phase 4. So wait patiently. We don't wait patiently. We don't have patience. We need to trade a lot. If any day I don't send the trade, I get the email. I didn't receive any trade today. Are you okay? Yes, I'm okay. 2 hours gone by, didn't receive any trade from you. Yesterday I received 3. Today 2 hours gone by. No trade. Are you okay? Before you send, if you don't send me an email in an hour, I'm gonna cancel my subscription. So that's the email coming. If you don't send me reply within 1 hour, I'm going to send you the cancellation. So okay, you know do that. These are some of the winners. So notice they're all calls and puts. So when the market is trending down, a lot of puts, and then suddenly you receive less puts, and then we till. So go on a phases. So the more the market is giving the signal, the more you're tilting or opening your position towards the call side or the long side. So market just failed to refuse to go down. So these are some of our recent, and I have other slides I'll show you. So you know. All these were beaten down stocks. So if you look at the chart, they are all beaten down during the last 2-3 months, and they all participating to the upside. So some of these stocks, they have gone up parabolic. So only go long in these if they have a significant some pullback to a meaningful support. Then you, so if any day the stock is just moving up, there are so many stocks, they're just moving up. So we cannot go long because there is no exit. So you can't, if you don't recognize the exit, you cannot enter. So, or some kind of a signal that you say, okay, this is what it will tell me that I need to close my position. I will be wrong. So these are some of the winners, and they are all extended, overextended. So I'm trying to find something good. So I have to do the homework. So there are 500-600 symbols, and then I go and look at when I run out of all these big Momo stocks like Apple, Baidu, etc. Then I say, okay, I need to find something on a small cap. So because small caps are moving, so I need to build a new database of all the small caps. I have to do a lot of work at nighttime to go through the small caps stocks. So there are 8,000 stocks. So out of 8,000, not every stock qualify. And especially if I'm looking for calls or to trade puts or calls, not I don't trade puts on a small cap because they are already small. And then what's the point of trading puts on a small cap? So only to go long. So either calls. So I'm looking at those stocks which have option and a decent option. So I can buy the options at $1 or $1.50. And it's not because they are $1.50, but they are, that's where the lot of traders are trading these small, and they do rise 25%, 50% move in a small cap. If a small cap is $5 and it goes to $6, is a 20% gain in the stock. So it's huge, but it can tank also. So once the big boys are run out, then I look for those dull some stock they are boring, so they start to move. So or something gap down due to earning, like today Intel. So Intel looks like it gapped down, and it gapped down at the support, and today's gap down low was the low. So all these, when the earning come, then it excites me. When the earning comes in this kind of market and the stock tank, then I put it on my radar. I say, okay, I ran out of the stock, earning came, and there's a stock gap down and pulling back. So let's put this on my watch list. So it on the watch list, it's stock, keep stocking, and then suddenly it just starts to move up. And the so I have a new, it's like a new bread. Okay, I ran out of bread, but this is a fresh bread. I'm going to eat this one. So I'll show you 6 charts of various reversal. So I'm showing you some charts of various reversal signal. So I'm always looking for, I love to watch the change in trend. So I love to watch, uh, and the question is the Dow, what you watch to determine trend phases 2, 3, 4, and 5. No, it could be any market. It could be Dow Jones, it could be S&P, Russell. I watch all four. So when you are analyzing the market, you have to, some are leaders and some are laggers. So some are leader markets, some are laggers. Right now, I think Dow Jones is the leader, still have, but the Nasdaq is like, looks like it's waiting for pullback. So I do have calls in DIA. So I traded QQQ calls, made money. Then so when we switch. So at any given time, we need to analyze which market has more potential. So Dow Jones look like have more potential, and it only have 30 stocks. So if you look at the Dow Jones, then Caterpillar and DI, the Boeing, etc. I had Caterpillar long position. I closed it today because I mean earning coming up, so I closed it. So I watch Boeing, I watch American Express, etc. Whatever the Dow Jones 30. 30 stocks. So not all 30 stocks are tradable with options. Some are really boring. So maybe out of 30 is 10. So in order for the market um, reversal, we need to watch all four markets. Maybe the bond market also, who knows? You need to watch bond market. So watch bond market. So I do watch all four. And I watch the ETF related to four, and then I watch the futures market. But it's the cash for cash big, these four: Dow Jones, S&P, Russell, and 2000, and the S&P and the Nasdaq. So I watch all. So I love to watch the change in the trend, because that's where the money is. When you recognize, I wish I can catch all of the stocks. Some of the stocks I see, especially the small cap, I say, oh damn, I wish I knew this two weeks ago when it was just trading at $2. Now it's at $10. So detecting the change in the trend is very important. This is where we make a lot of money, and our risk is less, because if you're wrong, if what was the what the signal you were looking at for the, let's say we are looking at bottom reversal. So if we are wrong, then we are wrong immediately. We can see that, oh, um, I was looking at this reversal signal. So let's say this is a reversal bar. Whatever bar it is, it's just a straight line right now. There's no, this is not a candle, this is not uh, a high low open. So just a high, you just think this is a low, and I don't know where it's open and closed, but you recognize something happened, this market was tanking, and then you recognize that this is a reversal bar. So once you detect the reversal bar, that this is the reversal, so it doesn't mean the next day we go and buy, go long. We need to wait, because we don't have deep pockets. So compounding effect and the turnover. So if you understand the compounding and the turnover, your money needs to be rolling. You don't want to, even though you could be right, but you don't want to be right after 10 years. I was right. I bought this stock in January of 2023, and now it's moving. So I was right. So we don't want to be. We want to be right away. If we are a, you know, even if you're a long-term trader, you need to be right somehow. So immediately, so the duration should be less. and especially if we are trading options. So if the reversal signal came here, I've done the study and it doesn't work. If I go immediately long, uh, most of the time it doesn't work. So I note down my option price I bought when I got the reversal, and finally when the stock takes off, then I compare by if it's 5 days or 6 days or 7 days. In during that period, my option lost money. So when the final the the move is happening, the option is trading at below price I bought, so I have to buy more. So I have to be careful in going early, but knowing that this is a reversal bar. So something will happen, something I'm looking for, which validate my thesis that the market is reversing. So some evidence. So I'm looking for some evidence or some discovery that this is I guessed it correctly, and now I'm looking for some kind of confirmation. So the market can give you the reversal signal here, and then it can go down here. So maybe it's going through the phase 2 and 3, but you want to, if you want to really make money, you need to identify phase 4. So this is where the money is. So the market can be doing the phase 3 or 2. You recognize some kind of a reversal signal. So since we don't have deep pocket millions and millions that we can buy and hold, we are looking for some kind of a signal which tells us, okay, this is the phase 4 started. Now I need to get in. So and the phase 4 have many phases, mini phases. So you can say 4A, 4B, 4C, 4D, and one also have 1A, 1B, 1C, 1D. So many phases. So at least we recognize this. So if we recognize that this is a reversal bar, so it's like, we wax our ear. Nothing can make us, I mean, market can tank, it's okay, but nothing can come and tell you that you need to change your belief. That maybe you change your belief because you recognize. I'll show you the chart where you have to change your belief that the market is gave the reversal signal. Uh, but till you get the evidence, you don't change your belief. It looks very enticing to buy puts. So market um, we lose money in this phase when the market gave us the reversal signal and we fail to recognize, and then we try to short again and then get clobbered, then we try to short and then we get clobbered, and the market just trap us and takes off. So the reversal signal can come here and the market breakout can happen after a week or 10 days. So we have to be patient. So we need to do the homework, put that symbol in the watch list, put some kind of a criteria that if the stock give let's say the criteria could be market made a new 2-day high, so you get the alert, or market is this market is moving, so you can see on your screen that it's going up. It did a breakout on a 60-minute. It made a new high today on a 60-minute bar, or or it closed higher than yesterday, or it closed higher than 2 days high. So whatever, it closed above the 2-day low. So some kind of a setup you have where you say, okay, this market is closing above the 2-day low. This market closed above the 2-day high. This is moving. Like you can see that it comes in your, like it comes in front of you many times. So pay attention. You don't want to catch this reversal signal here and you're catching it here because you want to feel good. Sometimes we want to feel good. We say, oh, okay, I'm giving in, I'm gonna buy here. I saw this reversal here and I miss all this rally. I was right, I need to buy something, and then you buy here. So you missed it. You need to buy somewhere here. So some kind of a signal you need to, if you have a reversal signal here, then this is your patience zone. You have to be patient. And then some kind of a signal which tells you that um, so the signal could come in the form of, let's say, uh, most of the time, the market, when it tries to rally, it fails the first rally and then it pulls back. And then the second attempt is the so genuine. So maybe you have a strategy for the second attempt. So you say, okay, I'm not if the breakout occurs somewhere out of this congestion zone, it could be a gap up or it could be some volume building up, some kind of signal. But maybe you have a strategy that you don't want to get in on the first attempt, so you wait for the retracement. Maybe you have a strategy for retracement that, okay, Yesterday it moved to $3. If it moves down 50%, $1.50, and then bounce up, I get in. Maybe you have a strategy to scale in. So you say, okay, no, no, no. Uh, I don't want to wait. So on the first attempt, I buy 1/3 of my position. So maybe that's your strategy. You say, okay, on the first attempt, I'll buy 1/3. So if I lose only on my 1/3 position. So I will lose little, but then when it moves up, I don't mind buying at a little higher price. Maybe you get at the same price. Most of the time, when the second attempt is happening at the same price. You're getting in at the same price. If you note down your price, especially in option, you're getting the same price. Um, uh, you know, so even though the stock is trading a little higher, but the option is trading at the same price. So buy 1/3 the first attempt maybe, and then pull back, then the second, and then you add. So you have a strategy for scaling in. So scale in dollar cost average because now you believe in your trade. So dollar cost will make you a lot of money. So instead of dumping in any pullback, you have the opportunity to buy. So the reversal signal came here, the breakout somewhere. You need to recognize what you are looking for. So this is one. Now this is another signal. So this one, reversal signal, same chart. So you see the same kind of chart. The market is tanking. You recognize this reversal signal. So you kind of feeling good that, okay, I recognize this reversal signal. So I will not go short and I will buy go long. So market, this is the first attempt after the reversal signal, so first attempt up. You initiated. So again, remember as there are time when the reversal signal comes, let's say on Friday, the market just goes up on Monday. So, but if you evaluate all those cases, maybe the percentage is less. So if the percentage is less for the market to make a V turn, then your odd is to wait. So you need to wait. So again, some kind of the market um, takes time to. Sometimes the market is just fooling on the first attempt. So if whatever you're looking at the reversal signal here, you're not the only genius here to identify the reversal signal. There are traders, many traders, far smarter than us. They also recognize this and they buy it. But then they are very disciplined. So they are exiting when this low is violated. So in this reversal signal, the 3 days of 1 day of up move, then 2 days of a same move. The fourth day, the market look like, yes, it's finally is moving. So everybody is happy and you are happy also, you bought here, but then it falls. So you have to have a stop somewhere here because this was your original thesis. This was your original reason to go long, and this going long is no longer valid on this bar. So on this bar, the signal, what the thesis you had is negated by this bar. So if there's some kind of so if you recognize here the second bar here, then you need to exit, and this is your final. So whatever thesis you had is negated here. So don't don't hold on to this position. Close it, and if it whiffs off, then it must go up. It comes back up immediately. If otherwise, you see the again another phase is started. So the phase is like this. Um, so it could be phase 3 here, and the market moves. It looks like it's gonna start the phase 4, but then it starts another leg down. Another phase 1 starts below phase 3. So we think, okay, got the signal here. It's phase 4, and then market reverses and create another phase 1. So it's another leg journey down. So we don't want to get caught and stay. So you just and the reason we don't want to get out because we invest heavily in that position. So you see the like people say, oh, I'm emotionally invested in it, psychologically, financially, I cannot get. So that's what happened when we trade in one position, that we get paralyzed. So if we cut down and think in terms of bets, think in terms of a game, then and we spread out our bets, we make a lot of money. When we put our capital in one trade, that trade we cannot get out, and that hurts. So spread your bet, create, like, ideally the experts say you should have 40-50 positions in the market, and you manage all those. So it's hard to manage all those 40-50 positions. So think about it, managing all those 40-50. So I have automated so much, and I'm still automating to manage just my positions. So this is a reverse failure of the reversal signal. Now, this is a V-shaped recovery. So you recognize this reversal signal, and the next day the market moves up, and maybe you got on the third day, so on the 2 days later, you got some kind of a confirmation that this reversal signal is true. So you see the same thing happening here. Market is coming down, same kind of reversal. So again, it depends also what kind of a reversal signal. So reversal signals come in various shapes and forms. It's not just one thing you Google and say, okay, I'm gonna Google reversal signal, and that's it. And then so it comes in various shapes and forms. So um, you need to handle. So it's like um, when your car break down or something. I give you example. The mechanic or somebody, they fix it. they they based on the experience, they come and fix it things. Magically they eventually figure it out what's the problem, like open the hood, and then he goes down, his head is buried in the, in the where the machine, your engine is, and then finally he comes out, and then he say, okay, I found the problem, and this is the problem, and this is the solution, and then you fix it, and then you go. So same way, so different reversal signals are coming. So some reversal signals are powerful, and not only one bar is giving you the signal, in conjunction with multiple bars. So not only just one bar tells you, okay, this is a ding ding ding, reversal, I'm going up. No. So there, what else is happening nearby, and what else has happened before in the same price zone? So maybe it's a demand zone, maybe it's a strong support, maybe there's a moving average, maybe I'm looking for something else. Maybe the overall market is about to reverse. So everything is going to reverse. So this reversal signal happen in multiple stocks. So overall, the market was moving down, and suddenly at like 12 noon, maybe FOMC news came at 11 on Wednesday, and everything, every like majority of the symbols in your baskets giving the same kind of things, reversal signals. So that is even more powerful when the majority of your stocks in your basket are putting on some kind of so reversal based on some major news came. So some event occurred. So some event occurring, all the stocks were getting clobbered, and now they are exhibiting the same kind of reversal signal. And if you can do the time analysis, so there is a time analysis where traders do. I try to do it, but I don't rely 100%. So there is a time where you can know in advance at what date the market can put the reversal. So January 4th was known in advance. So January 4th was known in advance. So it's not 100% reliable, but at least you know that this is some kind of a date is coming for some reversal. And then the event occurs. So when the event occurs on a date where you are in some kind of a zone, so give and take 1 or 2 days in that zone, some event occurring, and all the markets were, all the symbols were tanking, and then they give you the reversal signal. So all of them are exhibiting same kind of a reversal, intraday reversal. So intraday reversal is more powerful. When intraday reversal is happening, then the next day, if you're an aggressive trader, then next day comes your entry. So some kind of an entry you're looking for. If you're aggressive, you saw the reversal intraday happening, but then you want to wait, like give one more day, and you say, okay, I saw this intraday reversal, and in many stocks in the same group or overall, I just give one more day. So you don't want to get caught. So just prepare your basket, and the next day you initiate your position. So you can initiate your position. It depends what kind of a reversal you got. You can initiate with 1/2 position or full position or 1/3 position, something, and then just keeps going. So the same bars going down, but major things are happening. You don't know. we don't know what happened where the market reversed. So it could be overall market, it could be that industry, it could be that sector, it could be whatever. Something happened. Here is some more our winners. So you see the number of puts are less. So J&J, LLY, they are pharma, and CNQ. So whatever was happening, so the puts. So this is a little earlier puts, earlier trades. So the calls were here and a mix. So as the market is moving, when the market is in going through this phase, your mix is tilting towards the long, and your shorts positions are getting reduced, and then by when the market phase 4 starts and starts to kick in, then you don't have any short position. Okay. Well, you know, design until a day or two or three. Yeah. Um, reversal. So it depends also on the so again, it depends on the kind of reversal you're seeing, the kind of overall the market is telling you. Um, if it's an intraday reversal is powerful, it also depends on what kind of trader, what kind of who you are, conservative, aggressive, speculator. So who you are, what kind of account you have, is it option account? So many things goes on to decide when to put on the trade. So I usually wait. So when I see the reversal, today I went long on Intel. So when it gapped down immediately, I looked at it, and so I said, okay, this is the low has been made. So what happened when Intel went down, gapped down, the open and low close, open and low was the same. So it stayed in open and low uh, price. So the net change, if you look at the open and the close, meaning the close at the time, particular time, like let's say 7 o'clock in the morning Pacific. So I kept watching. I said, okay, I believe this is a gap down, is just gap down today. This is the end of, not the end, just gap down, and that's it. So kept watching on a, so I immediately put it on. I will not know what is happening on a day chart. On a day chart, the stock is just sitting there. It's like a twinkle, twinkle, little star. It's just there, open, and the last price is same. But then on a 5-minute chart, you can start to see that is refusing to go down. So I initiate my Intel position. So not all, tomorrow or 2 days or 3 days later on Wednesday, Thursday, it will give you more like, yeah, really I'm going up. So Intel, in my opinion, had a low on a gap down. But I don't mind if it goes on a below Friday's low, then you get out. So here is the reversal, top reversal. So same way, the bottom reversal, if you flip your chart, is the top at the top side. So the market can rally, and then gives you some kind of a signal, reversal signal. So if it gives you reversal signal, and if you have a long position, you first of all you need to exit. So there or some overbought level or some resistance. So whatever happens, some kind of a signal you saw, that you need to exit from your long position. So let's say Caterpillar. So I see, okay, Caterpillar, you moved, you reach, and now earning coming up, and I need to exit from long position. So it doesn't mean that I immediately go and put the short position. So I receive email, okay, this one I exited is extended, and I'm going to put some short. I don't know how people can trade like they're talking about Tesla. Okay, time to put some shorts on Tesla. I don't know, maybe it goes to 250 and I will lose my sleep. I cannot put the short like that. Okay, time to put short on Tesla. It moved from 100 to 180, so I cannot. And so I rather make less money and be happy. So some kind of a breakdown I need to see. So we need to see the breakdown to be uh, Be smart. You don't have to short Tesla. Maybe they are smart and the Tesla goes down next week. So find something else. You don't have to short. You can buy long. Shorting doesn't mean you is free. You have to put some money. So if the reversal signal come here, then look for some kind of activity at the top. So the market will tell you it may create a double top, it may create a triple top, it may gap up and then no move. It may create some kind of a small candles or something which tells you that this reversal signal and now the market is failing to go up. So it creates resistance. So the resistance starts to build. There was no resistance, but the resistance starts to build. That's what I saw in Eli Lilly. That's what I saw in Lockheed Martin. So now I have a long position in Lockheed Martin. Before I had a short position. So the Lockheed Martin and Eli Lilly, if you look at the previous chart, they were doing the same thing, like um, ping pong. So they do the ping pong, and then the final breakdown comes somewhere here. So if you recognize the reversal signal here, you just put it on your watch list and watch it. If you're wrong, it will break out, and then your reversal is this was just a temporary, it was not, but you were on a lookout. So it's like on a lookout and exit, go short when you really start to get some more evidence. So the evidence may come here after 4 days. So some evidence, and then you go short. So whatever is your reversal signal here, there are many. So identify what works for you, what is reliable. Some are just exit signal from your long. They are not to go short. So there is a difference between exiting from long and putting on the short position. So there is no if you look at Tesla, there is no today move. It's not the short signal. Same here, top reversal. So reversal signal here came, and then you put on your evidence. You're looking for some evidence, and then the market did pull back one day, and then you think, okay, we may get caught. Who knows? You get caught here next day, and then the market moved up. So if the reversal signal came here, it should not violate the high of the reversal signal. So it should not. The market should not. So if you put on some shorts here, somewhere here, you are wrong on this bar, because you think and it looks correct that if this is a reversal signal, then this bar where the mouse is, this is the entry short. So you went short, but then the market gapped up and starts to move up. So immediately you recognize that this is not the I need to close it. So the earlier you close, the better off you are. And um, I mean that's the way it is. The earlier you close, the better off you are, because the market, especially in the short, the market just keeps going. It can wipe you out in the short. So be careful. Now the top reversal signal, so just like a V shape bottom. So sometimes we get the reversal and then the next day. So what I like in the top, if I get some feeling that okay, this is the reversal. If the market gaps down very next day, then it's kind of some kind of urgency for me to go short. If I put this symbol based on some kind of a reversal, and I put it on my watch list, and then I have urgent. Then I next day I see it gapping down, so then I have immediate a kind of urgency, because the further, if it gaps down, first of all, I think I'm right, and it gap down, and if I wait for further move, then I'm staying away from my exit in case I'm wrong. So once the stock gaps down, I really need to hurry up and figure it out the entry, because then if I'm wrong and the market is moving, I'm giving all kind of excuses that the gap needs to be filled, it needs to go above some kind of movement here, maybe it needs to go above the high. So I put all this kind of excuse to get out, so I will lose more money if I'm wrong. So if I got the reversal signal here and the market gap down, that's immediate signal for me to go short. I cannot wait now. So just transfer your chart into 5 minutes to make sure that you are not overlooking something, and go short. If you're wrong immediately, because the market, after gapping down, giving you the reversal signal and gapping down, it should not go above the high of that bar. So it should not go above the high of the bar. So pay attention. So detecting the change in the trend is so various phases of the market gives us money. Detecting the change in the trend in the early, whether it's a overall market or whether individual market, gives us money. Then another, when the market is moving up, then you're looking for some kind of a pullback, and the pullback needs to be at proper support. So look for those symbols where the market pulled back due to some news came, earning news and this and that. That's temporary, and then it's reversing. So that's another strategy. The third could be that you keep looking for new symbol, the laggards. So you can build, and once you exhaust all this, then there is nothing there. Then it means the market has reached the top. The less symbol you find to trade, it means the market is reaching the top. If you find the less and less and less and less symbols, so you ran out. You ran out of Apple. You ran out of Baba, Baidu, Tesla, and all that is so Caterpillar, Home Depot, Lowe's, all these. So then you look for something new. Something is moving. Well, these stocks have already gone. So look for some brand new candidate which are doing something new, or wait for 2 3 days of a pullback and everybody is saying, okay, it's time to go short, and then the market reverses. So at that time you have a brand new symbols to trade. So have to keep working every day. So this weekend I will work. I will prepare all my list, what is new, and I'll put it on the watch list. So it's a, except on a weekend, instead of doing at night, I do it on a weekend. So not on Saturday, most likely Sunday afternoon. So I'll do it on Sunday afternoon. It's just, but every day you need to do the homework. If you don't do your homework after the market is closed, and you don't come to the market early, it's like in the old days, people used to wake up and go out and pick up the newspaper, and then they come and then they read the newspaper. So same, if you are not getting up early and opening your door and go out and see the newspaper, in the old days, and see the milkman delivering, then you're not going to make money in the stock market. People say, okay, I wake up, I come at 9 o'clock. So by the time it's done, by 9 o'clock, I am going to do something else. 9 Pacific, I'm getting ready to do something else. I'm not getting ready to trade and see what is there. So, but it's done. So you need to wake up early, 1.5 hour early, and be ready. And then, so imagine if you identify the reversal signal and the market gap down, and if you come to market 3 hours later, it's already gone. The profit is already gone. So you're late. So you need to do some homework at night time, wake up early, prepare yourself mentally, do some mental rehearsal, look at the news, read the news, look at the open position. If you have to talk to your trading buddy, you talk, you make sure internet working, everything is quiet, and your mouse is working and internet there, and you're ready. You just can't wait. It's like 6:27, now it's 6:28 a.m. Okay, 6:30. Okay, the market has started. So everything okay? Alerts are coming. Yes, alerts coming. This. I need to watch this. I need to put this symbol in here. I need to push that. This one is slipping by. I have to close this position, then I will take care of this position to open. Let me see this, let me see that. So you have to do a lot of homework. But if you walk quietly, nicely, 9 o'clock, open your app on Robinhood, and just decide it's not going to work. Here are some more symbols, the recent winners. So COF was the earning. If I remember, I'll prepare the chart and show you. So these Tesla calls, we made a lot of money on January 3, 150 call is not mentioned here. So this is another. So all these have some reason to, and then you see most of them are calls. So only one put. Most of them are calls. So as the market is tilting, you're shifting your positions towards calls and closing out your short position. So that's where the money is, and the portfolio rocket upward. Once you get into the rhythm, your portfolio is aligned with the market. So I stop here, and I will see you next time. what is it? Is what you call individual market a specific stock? Yes. Individual stock is also call it the market. So it could be Tesla. It's a market. So just call it a market. So individual symbol is a market, and overall market is a market. So yeah. So it's same. That market. So that market means Tesla or Workday or Guild or ARKK. So market. Yes. All right. So it's dinner time for a lot of people. So I'll see you sometime, maybe Monday. Okay. Thank you.